So this is the part of the show where I talk about what I believe is important for individual investors to consider over the next few weeks when you make your investment decisions. I know a lot of people recently aren't making many investment decisions. Speaking to a few clients, they're very reluctant to put money to work at this time, but I think that could be a mistake. I think it takes an iron stomach to be making some investment decisions when everybody else seems to be fearful. But as we all know, and as I've said many times on the show, that's probably the best time to be looking at making some good investment decisions. So what are the three topics this week that I think individual investors should focus on? First, economic data. I talk about economic data all the time because the markets are moving on it. Inflation data. We saw recently Canadian inflation down to 6.9%, down from about 8% that we saw at peak. US inflation down to about 8% from over 9% we saw at the peak. We also want to focus on what the consumer is doing. Are they still spending? What's their sentiment? Are they more negative, more pessimistic? The answer is yes. We've seen consumer sentiment numbers, the lowest we've seen in quite some time. The consumer is pessimistic. They believe that there is a greater than a 50-50 chance that we will be in a recession come the first half of 2023. And even comments by the Bank of Canada as early as or most recently as this morning, telling us that there's a decent chance we could see a mild recession or definitely a slowdown in the first half of 2023 based on the number of rate hikes that we've seen in 2022. So economic data is going to play a big factor. And I think we have a chart which shows a bit of the data, inflation, interest rate hikes in the same chart. If you want to put that one up, there it is. And you can see September 2022, 6.9% is the inflation rate. You can see excluding food and energy, obviously lower, but still almost approaching 6%. I think the Bank of Canada said this morning that anything we've seen, that reduction from 8 to 6.9 really is because of lower oil prices. Pretty much food prices still remain high. You can see here in this chart the overnight interest rate versus the inflation rate, how much interest rates have gone higher. And yes, the inflation rate has ticked down because of that. I think we have one last chart there on food prices, and you can see how much food prices have gone up. Food prices rose 11.4% year over year in September, which is huge. Cereal, coffee, non-alcoholic drinks, etc. These are staggering numbers, and we're not alone, right? We continue to see inflation as an issue down south, wage inflation, food inflation. So I guess the central banks, they're in agreement that we're seeing a softness in the economy, and that is definitely helping inflation tick down. But they still believe that most of that inflation dropping is due to lower oil prices. So we need to keep an eye on economic data, future interest rates. And I think that's going to lead us or give us a good indication as to the path for the stock market. The second point I think individual investors should focus on are corporate earnings. We're right in the heart of US corporate earnings. We've just, scratched the surface or just started the Canadian corporate earnings season. CN Rail just reported earnings over the last 24 hours, and their earnings came in really, really good. They actually took up their expectations going forward. So CN Rail is telling us that they're still shipping everything from grains to oil to you name it on their trains. And that's a great sign. That tells us that the economy is still moving forward. But there are a lot of corporations, especially in the US, that have disappointed us. Most recently, last night, we saw Alphabet, formerly known as Google, disappoint all of us. And they did not meet the expectation. They talk about a slowdown in advertising spending. We heard from Snap. We're going to hear from Meta, formerly known as Facebook, tomorrow, actually today after the bell, and we'll see what they say. Obviously, the Metas or the Facebooks of the world, the Alphabets, the Snaps, these are companies that really depend on businesses, small businesses, large businesses, spending money to grow their business. And we're seeing a definite slowdown in Google or Alphabet, and we'll see what Meta. There's a chart of Meta there, down almost 60% this year alone in their stock price. Lastly, we heard from Microsoft last night. They actually beat on both the top line growth, revenue growth, and bottom line growth once you factor in, all their expenses. Yet Microsoft is down also 5% today because we saw a big part of their business, which is the cloud business. Some of you may have heard of everything's in the cloud these days. Nothing is on servers. It's all up in the cloud. And their cloud business has definitely slowed. Azure is definitely slowed. I guess the main message we're getting from a lot of these corporations is things are slowing down. There is no doubt about that. A lot of businesses are talking about slowing profits, slowing profitability. But at the same time, it's not as bad as many had feared. So not as bad as it could be, yet slowing growth. And as an investor, I think you want to parse through a lot of these corporations before you make your investment decisions to figure out which one of these names is going to be worth it to buy. A lot of these names are down 20, 30+%. Which ones do you want to buy on the cheap? Which ones make sense? And which ones will be higher 6, 12, 18 months from now? The last, topic that I think individual investors should focus on before they make their investment decisions is overall portfolio or asset mix. And what I mean by that is the asset mix in your portfolio. For the longest time, we talked about TINA. There is no alternative, which is what TINA stands for. I talked about it on this show, that if you wanted to get ahead, you had to invest in the stock market. There was no alternative to the stock market. Yields on bonds and GICs were 1%, if that. Well, today, those same products that were maybe 1%, 2% are now paying 4, 5%, even closer, maybe closer to 5% than 4%. So you could buy a good quality corporate bond and it could yield for you just under 5%. Now, when you look at where the inflation rate is in this country, 6.9, or just let's say roughly 7, you're still not keeping up with the rising costs. Looking back, in my career, the last time I sold a GIC somewhere in 1999, yes, a long time ago, 22 years ago, that was when GICs for 1 year were 6.25, and the inflation rate was somewhere around 2.5, 3%. So you could actually get ahead by owning some of these ideas, fixed products, GICs in particular. And really, since then, I haven't been a big proponent of GICs. Flexibility is an issue. Getting out when you want, you obviously can't. You have to wait till the GIC matures. And if you look back in history, there have been very few periods of time where GICs actually make individual investors money after you factor in taxes and inflation. So not a great option. However, today, bonds paying closer to 5, GICs are an option. And why are they an option? For the safer part or the low risk part of a portfolio. So if you were to do a classic 50-50 split or 60-40 split, 60 equities or the stock market investing, or 50% in the stock market and 40 or 50% outside, you could count on now a 5% or almost 5% rate of return on your low risk money, and then perhaps maybe a 10, 12% on your medium risk or equity component of your portfolio. And if you average the two, perhaps you're coming somewhere in and around 8%. So portfolio mix is really important. And you can see here, this is just an example of a portfolio mix for someone who's retired. Perhaps you want 50% in fixed income, and then the other 50% is scattered amongst other asset classes. One thing I will say before we leave this topic is understand and have the right expectations regarding fixed income. Understand the opportunity cost, perhaps. And there is an opportunity cost. If you are going to buy a bond or GIC, and it's a 1, 2, or 3 year or greater investment, greater term investment, longer term investment, what is the opportunity cost? Well, if you were to go into the equity market today or the stock market, and let's say you were to choose a simple investment, shares of Bank of Nova Scotia. Well, Bank of Nova Scotia today pays over a 6% dividend yield, and that stock is down by roughly 30% from its highs. So would you want to choose investing in Scotia Bank? The yields are higher than the yields you're going to get on a 1 year bond or GIC. Plus, you have potential to perhaps I see a rebound in that stock. Now, maybe you don't see all 30% in a given year, but maybe you make back half. Very possible. We've seen markets jump when things are good. So what is the opportunity cost from parking money? A lot of clients or investors I've talked to recently, they're a little nervous about putting more money to work. They want to see things hit bottom. Well, unfortunately, we just don't know when things will hit bottom. And if you wait for that bottom, you may miss out on an opportunity. But if you were to invest in the market today and that investment then goes down, I'm still, and we still can be confident that you own a good quality investment. Eventually, that investment will rise and you will see the returns. But if you don't get involved or invest in the market, you could miss out. So even if you're in early and don't wait to see that bottom, which nobody can foresee, trying to time a bottom of a market is impossible. But if you get in too early and the market falls, stay patient. That market's going to rebound at some point. So at some point, if it's a good quality investment, like the Scotiabank stock, for example, I think you will realize the gains that are coming to you and that you anticipated and expect when you bought that stock. So understand the asset mix that you have, understand that there are other opportunities to put your money into, but understand what they're going to do to your portfolio and how they're going to affect the returns of that portfolio.